Think of a standard game night. You sit down at the table, the banker hands out a specific pile of colorful cash to everyone, and you all play by the exact same rules. We usually assume the real-world economy works the same way, with the government acting as the banker, loading up massive sheets of paper on a printing press at the US Mint. But imagine if, halfway through the game, the banker pulled out a tablet and started typing extra zeros into their account, increasing their balance with just a few taps. This digital expansion is how the modern financial system actually functions. Instead of relying on physical paper, the total supply of money grows through computer networks and electronic entries. Understanding this hidden digital mechanism explains why a trip to the grocery store feels so expensive today, and it reveals how the wealthy manage to keep ahead of the system. The process begins when the US government spends more money than it collects in taxes. This creates a massive gap that needs to be filled. To bridge that gap, the Treasury creates documents called bonds. These are essentially formal IOUs that promise to pay the holder back later with a little extra interest for their trouble. The Federal Reserve, the nation's central bank, is the primary entity that buys these government promises. To pay for these bonds, the Fed simply creates new money on a computer. They don't use tax dollars or savings. They just credit the accounts of banks with a few strokes of a keyboard. These digital dollars are instantly added to the banking system as reserves. This is money that did not exist anywhere in the world yesterday. Our money supply today consists of these digital entries and the government debt they represent, rather than physical gold or piles of paper cash. Those new digital reserves eventually flow from the Fed to the commercial banks where everyday people keep their accounts. When you walk into a bank to get a loan for a new house or a business, it feels like the bank is giving you money that another customer previously deposited. In reality, the bank uses those reserves from the government as a license to type a brand new deposit directly into your account. A single digital reserve from the Fed acts as a seed that sprouts into dozens of new, larger loans. Because banks only hold a fraction of the original money to back these accounts, every single loan expands the total dollars circulating in the economy. This means the vast majority of the money we use every day is actually printed whenever regular people borrow from a bank. Going back to our game board, we can see that the playing surface is now completely covered in all this new digital loan money. The physical world doesn't grow at the same speed as those digital keystrokes. We haven't produced more land or more raw materials to match the flood of new cash. The amount of stuff stays relatively the same. When a massive amount of new money chases the same amount of goods, prices have to rise. This is the simple math of inflation. Rising costs are a mathematical certainty in a debt-based system. When new money is constantly added to the pile, the value of every individual dollar naturally thins out. In this environment, the players who follow traditional advice often struggle. Consider the saver, the person who works for a paycheck and keeps their cash in a standard bank account. This chart shows the shrinking purchasing power of a $1,000 savings balance over 10 years. As the total money supply grows, the price of goods climbs higher, meaning those static savings buy less and less every year. Inflation acts like an invisible tax. It erodes the value of your work and your time without ever touching your physical bank balance. However, the player who borrowed money to buy a house or a business sees a different result. As the money supply grows, the price of their property rises, effectively increasing their wealth. These mechanics create a steady current, moving purchasing power away from those who save cash and toward those who hold the assets that the new money is chasing. To thrive in this system, you have to stop viewing cash as a long-term way to store the value of your labor. A more effective strategy is to own real assets. Things like real estate or shares in productive businesses naturally tend to rise in price as the dollar falls in value. Professional investors often use debt strategically to acquire these assets. They understand that future inflation will actually make those loan payments feel cheaper and easier to pay back over time. Once you understand that the money supply is a digital tally that grows through debt, the rules of the game change. you can stop being frustrated by the system and start making choices that help you